Budget Personnel Committee meeting to order for Monterey One Water on Friday, April 11th. We'll start out with roll call.
Castroville,
Here.
Marina Coast,
Here.
Monterey,
Here.
Sand City. Here.
Okay, is there any additions to the agenda?
No additions.
Committee members, staff, nothing? Okay. Entertain a motion for approval of the agenda.
So move. Second.
Motion, we got a second. All those in favor say aye.
Aye.
And carries unanimous. Now's the time for public comments. Anyone wishing to address this committee on items not on today's agenda, do so now. Nothing? Don't see anybody. Okay, we'll close public comments. Move on to number 6. Consider approval of a budget personnel committee minutes, March 14th at 2:25.
So move.
Second.
Any discussion from the public? Questions? Okay, all those in favor say aye.
Aye.
Motion carries unanimous. Item 7, consider recommending awarding a professional services agreement to Chandler Asset Management for investment management and advisory services. We're going to Lawrence or Paul?
Lawrence on this one.
Okay,
Okay, good morning. My name is Lawrence Chiu, Director of Finance of the Monterey One Water. Today, I'm presenting the proposed contract with Chandler Asset Management for the investment management and advisory service. Let's go to slide number 2.
Vince.
Okay,
So as we're waiting for that, I'm just going to give a little background because Tom brought this up to me about a year ago on investment services that we've been looking into. At that point in time, we were and continue to be self-management of our reserve funds. We did diversify a little bit between LAIF and the county fund and some other things based on looking into it. But the intent was always to put out a request for proposal to get a professional financial management firm to take care of most of this for us beyond obviously what we need as liquid. So Lawrence has ran with that and put out an RFP, which he'll talk about, and then of course a selection. So it's sort of something we've been meaning to do, and it's getting done now, which we're very appreciative of.
okay, we're looking at slide number 2. Our investment goal is for safety, liquidity, and yield. The current investment approach is very passive. We park most of the money in the pool investment. For example, 40% of our fund park in the local agency investment fund, 5% with California Asset Management Program, 15% with the Monterey County Investment Pool, and the rest is in the deposit in the U.S. Bank swept account. So over the years, we identify opportunity to diversify the investment portfolio and to transition from a passively management investment portfolio to a active management investment portfolio. Next slide, please. So Finance Department issued the RFP in February this year, and the response is still in March. And totally, we received 7 proposals. Based on the proposal, we rate the proposal and we form a internal evaluation committee, which include the Director of Finance, Community Relations Director, and the Deputy Director of Finance. And based on that, 3 companies were invited to a final presentation to the Finance Department. And the evaluation committee select Chandler Asset Management. It's based on the strong presence in the California, especially in the water and wastewater agency. And they have a very strong client servicing model. And they developed a very transparent and strategic portfolio for the agency. And they will present that shortly. Next slide, please. So staff recommend a 3-year contract with Chandler Asset Management with 2 options, 1-year renewal. With the contract, Chandler will assist the agency to develop and build a strategic and diversified investment portfolio that is extremely important. Assuming that the asset under management is 80 million, here's the fee for the three fund owners. Chandler, the estimate fee is around $63,000. And in the first year, they're going to give the agency a 10% discount. This will bring the fee down to $56,700. And the second firm that we interview is Media Public Funds. The proposed fee is $53,000. And the last company that we interview is PFM Asset Management is $48,000. And with that, I'm going to turn over to Chandler to talk about the investment portfolio and also the experience working with the water and wastewater district in California.
Good morning, directors. My name is Carlos Oblitas from Chandler Asset Management. Can you all hear me?
Yes.
Excellent. So I am a portfolio strategist, a senior portfolio strategist with Chandler's investment team. I'll be one of the primary contacts for the district in this engagement. As Lawrence just stated right before I spoke, we do have several decades of experience in working with local governments. If we turn to the very first page of the presentation before you, this is a brief overview of our firm. We're currently managing a little bit over $41 billion nationwide. On a dollar basis, that works out to be like 90% local governments. But on a headcount basis, when you start counting the number of firms, I think it's just the next page, if you're able to forward to that with a pie chart. If you start counting that on a headcount basis, we're somewhere upwards of 96, 97% of our clients are local governments. We are California-based, which is unique. To my knowledge, we're probably the only California-based firm in this space working for local governments. We've been doing this since 1988. My personal tenure in this is, I just celebrated my 30th year in providing investment advisory services in the fixed income space for local governments. Our firm was founded by local government.
Carlos, sorry to interrupt. We are having difficulties getting your presentation up and scrolling through the slides. Just wanted to tell you that.
Not a problem. If you'd like me to pause until that happens, I'm happy to do that.
Yeah, let's do that for a second.
You got it.
Paul, we also have the slides that been handed out that
Oh,
we can.
do you all
follow.
have that up there?
Yeah, they're on the dais.
Oh,
Just
and-
FYI
thank you.
to help.
Carlos, it looks like it magically appeared.
Okay, perfect. It's all good. So as you can see the pie chart there, we've got a little bit over 41 billion. That's as of December. We're now crunching our numbers through March, and I know that that's higher because we have been growing. And as we've grown, we've been adding staff to be able to expand our capacity to be able to handle all the management that we provide for local governments. As I stated earlier, we're headquartered in San Diego, and I think we're the only investment firm that provides this level of services to to local governments. Actually based in California, all the rest are based out of state. I myself, I'm in the Bay Area, but our portfolio management and trading operations are all in San Diego. My colleague, Victor Shin, who's here with me, is also here in the Bay Area with me. We work as a fiduciary. That means that we work as an agent on your behalf, and we are tasked with coming up with investment ideas and then carrying them through. So there's a lot of resources involved in order to do this, to run an efficient investment program so that you can meet your goals. And I think a lot about your goals. I had the opportunity, I mentioned earlier that I just celebrated 30 years in this industry. I had a chance in my career to spend a few years on my client's side of the table. I became a finance director at a special district, and it was a wastewater district. So I know the wastewater water space quite well. And I can tell you that when we think through building investment strategies that move the ball forward from a safety, from a liquidity, and from a return standpoint, we build those to support what you're doing from a financial perspective. Our strategies are going to be specific to you. This is not a cookie cutter approach. And we do this with a very experienced team of professionals, all local, all here in the state of California. If we go to the next page, This is just a brief overview. I believe one of the directors stated that you have this in front of you. You can look through these, but you can see several local governments that we work with. We work with City of Monterey, City of Salinas. We are also very active in the special district space, as you can see that, the Joint Powers Authorities. Some of the Molten Niguel in San Diego Water District, Calaveras County Water, their water and wastewater, South Coast Water, Vallejo Flood and Wastewater. So you can see just sort of through peruse through this list, and you'll see that the list is quite robust. And this is not exhaustive. This isn't every local government we work with. This is just the ones that we could fit on this page. If you turn to the next page, there's a brief page that focuses in more on water, wastewater. Those total about 3.7 billion and growing. Alameda County Water District is one. And this is also nationwide. Even though we're based in California, we are a nationwide firm, and you can get a good idea of who we're working with here. Coachella Valley Water, currently the largest one. From a wastewater district, I think Molten Niguel will be another big one that you can sort of just see there. The service, if we go to the next page, is comprehensive. It isn't just about managing investments. It's all the services that are related to make an investment program effective. It means that we have to be knowledgeable, we have to be experts on California government code, because your investments are governed by code. They're very, very regulated and restricted. And we are experts on California government code, and also the way that that spills through to your investment policy. Part of the job is to understand how to structure the investment program so that you have ongoing liquidity, as well as those reserves that you don't dip into. And that right there begs for two separate strategies. And thinking through that as it relates to your operations, to your CIP, how do we structure that? We think through all those things, and we help with that. We manage to targets. We report on those targets, and we use benchmarks to measure the success of our management. But it's about also credit analysis on the portfolio. These are fixed income securities, they're bonds, and ultimately a bond is a loan, and you're lending money out, and we want to make sure that you get your money back. And we mitigate that credit risk by doing extensive internal credit analysis. We're not just relying on a credit rating from the credit rating agencies, but it also includes ongoing presentations to stakeholders, to policymakers like you, to be at public meetings. It includes the monthly reporting that allows staff to accurately and effectively book all your earnings at month end. And then, of course, just keeping them updated on what's happening in the economy, what's happening in the capital markets. A lot is happening in the capital markets right now. And our job is to stay on top of that and keep you up to date on it. Let's go to the next page, and I think this is my final page, and I'll wrap up with this. It might be easiest to look at the graphic at the top of the page. This graphic is just a graphic outline of how we approach investment programs. We always start by reviewing the investment policy. If there is no policy, we write it. But basically, we look for three things. We look to make sure that the policy complies with California government code. We look for best practices that have been identified over the years from our experience, as well as from various industry groups, like the Municipal Treasurers Association, Government Finance Officers Association, and others. And we build those policies, thirdly, to make sure that they're readable, that people can understand them, and that they can be easily followed. That's our basis for the management of the program. It's our fences, if you will. From there, we work with staff typically to do some sort of analysis that allows us to delineate what monies of your investment program are needed for immediate liquidity, to make pension payments, to cover debt service, things like that, make payroll, AP runs, and what amount of money is not dipped into over the long run. And like I stated earlier, those are two different and distinct needs that require different approaches. And so we think through all these things. To a great degree, staff has already done this in your case. From there, we develop those strategies, and from there, we do the heavy lifting of looking at the opportunities, doing credit analysis on all the issuers in your portfolio, making sure that the strategy that we have is a good match for the liabilities that are coming up against you. We go to the capital markets and purchase these from broker dealers, primary broker dealers, and we do that in an efficient manner to get you the best pricing and the lowest cost when you're buying these securities. And then applying those principles of diversifying the portfolio from a sector basis, from a maturity basis, targeting a duration, and making sure that the credit work is extensive and thorough. But the idea here is to provide a disciplined approach to your investments. There has to be a reason for every single bond in your portfolio to exist. If it has no reason, it's not going to be in there. And we think very thoroughly, and our results, which have been presented in our proposal, have been quite strong over the years. The returns have been very, very competitive, and over the long run, at our cost basis, it comes out to be a very strong value proposition. As I stated, my role is to be part of the investment team. I have a voice in the process that sets our portfolios, but I'll also be your main contact. I've been doing this for a long time, but I want to pause, and perhaps you may have some questions that I may answer for you at this time.
Questions? Comments?
Do you want to go first, Mayor?
Sure. I just wanted to get an impression from staff. They identified in the report that even though this was the highest of the three, as far as overall cost proposals, they felt that this was the better approach given their investment approach and their quality of service that stood out. So I was just hoping that maybe staff could speak to that a little bit more in regards to what they saw as this that differentiated them from the other interviewed applicants.
Throughout the interview, we feel that like they develop a investment portfolio pretty much like customized to the need of our agency, especially like they're very experienced working on the CIP. That is extremely important because when you look at the CIP, always like a huge cash flow draw throughout the entire year. So they customize the program based on what we need in terms of the cash flow. And at the same time, they provide education to the staff on how to handle the investment. And also, they also provide service to update our investment policy on an annual basis. This is extremely critical. So we are in compliance with the stakeholder to present the updated investment policy to the director for review annually.
Okay, awesome. And then for Chandler, for Carlos, I'm hoping that maybe you could share any thoughts that you might have as it relates to M1W at this point. I mean, I know you haven't dove into your process yet and really doing the analysis, but from a really high level, could you maybe describe a little bit about what you see about our organization and where there might be some specific focus as it relates to M1W?
Absolutely. You know, and we provided some information, but we knew that we had to, we provided some information on this, but we knew that we had to keep this very, very short. So just to respect your time, but I can tell you that we looked at your policy. Your policy is robust. You have a good policy. We would augment the policy to include additional sectors that are available to you under California Government Code, for which we have very strong capabilities and resources in analyzing. That's one of the areas that we would like to explore with staff. The other area that we would like to explore with staff is you currently have a lot of liquidity, which in the long scheme of things is not a bad thing. I think you're all aware that short-term rates for a season for the last year and a half or so have provided outperformance because of some macroeconomic dynamics and action by the Federal Reserve. That you've taken advantage of that, and you've been very well paid for that. I think that the district has done a good job of that. But in colloquial terms, that ride is over. That's changing, and over the long run, that relationship is not a lasting relationship between interest rates. And your ability to get longer is going to be paramount down the line. It means that you have to start thinking about investments that are longer maturity and how do you enter into those and how do you select the right maturity ranges to be able to enhance the return in this portfolio. You're very liquid right now. It hasn't hurt you, but you're going to leave money on the table into the future, and we want to think through that. Lastly, when we're buying securities, maybe the best way to think about it is if you need a roll of paper towels, you generally don't want to go to the local 7-Eleven. You want to go to Costco because when you buy in bulk, you tend to do a lot better on a price basis. Well, you can apply that same concept to the capital markets and the bond world. Prices are. It really depends on who you're dealing with and what sort of volume you're buying in. We want to bring our buying power to the table so that we can lower the cost when you purchase securities and in turn end up with a higher yield. Those are three capabilities that we're going to focus on immediately and right off the bat.
Awesome. I appreciate that. My last little comment is I appreciate your work with the city of Monterey. You all provided a really good investment report for our city, so I appreciate the work that you all have done there.
Thank you for those kind words. I appreciate that very much.
Thank you very much. So one of my questions was going to be directed to Director Williamson about how satisfied the city of Monterey is with your service, but he's answered that question. So thank you very much. So I know that the law limits where we can invest our money in a variety of ways, and you've obviously indicated you're very cognizant of that. Could you, though, roughly describe the range of legal investments that you all might consider for us? It's a question.
Absolutely. Absolutely. Let me answer that question first. So because the objectives, and these objectives, by the way, are mandated by California government code. The district or Chandler did not come up with these. These are straight out of California code. The objectives are safety, followed by liquidity, followed by return. When you do that, the Chandler philosophy is that the backbone of any local government investment program has to be a good allocation to Treasury and agency securities. Currently, out of those two, the best value to be had are Treasuries, and we would introduce anywhere from 35 to 40% of the portfolio at the moment in Treasury securities. We would be looking, if there are deals to be had with federal agency bonds, we would be looking to add those. There hasn't been in a while that the spreads, the additional yield that you get paid for taking on that additional risk just hasn't been very compelling. We would be looking at very high credit quality corporate notes, although those right now tend to be a little bit on the, they've been, the spreads are tight. That means that they're a little bit expensive. You don't get paid as much. And then of course, because of the news, with the tariff, the tariff news that you've been seeing, you've seen that spread widening. They've cheapened a little bit again, so we have to be very careful entering those. But those over the long run could be part of your program. We would be looking at AAA rated supranational bonds. These are World Bank bonds allowed by code since 2014. U.S. Washington, D.C. dollar denominated and very well run. Those have full faith and credit from the U.S. government as well as all the other member nations. We would look in very small tranches. We would look to add pass-through securities that would include consumer receivables like pools of auto loans, very high credit quality and liquid. We'd be very careful entering into those. And also, we would be looking, if possible, to introduce federal agency mortgage-backed securities. Those have the full faith and backing of the federal agency, and that's the backstop for those, and they're quite strong. That's the beginning of it. That's what we would sort of gravitate towards. We've got good capabilities in managing those sectors and in analyzing the risk. It is a dynamic process. There are other sectors that are allowed by code, negotiable CDs, local CDs. We don't see as much value. They're just not as liquid in those, but there may be options for that in the future. Commercial paper is also allowed, and we would want that in the policy. That's a short-term unsecured promissory note for corporations, 9 months or shorter. But those wouldn't be appropriate for the longer duration strategy that we're thinking of for your more stable funds. That would be a good indication of where we would begin.
All right, thank you very much for that answer, and don't take what I'm about to say as one director suggesting you don't do this, but full faith of government agencies right now. Normally, I would have 99 to 100% full faith in government agencies, but under the current administration, I'm not so sure some of those agencies will even exist to provide full faith. But anyway, I'm sure you will work that into your calculus. You did say, as the state law states, that safety is sort of number one. The converse of safety is risk. Within that, even within the limit of what we're allowed to do in investments, is there not some, if you will, wiggle room for a board to say, we want you to be more conservative or less conservative and more chasing after more returns within the legal space? I mean, is there some wiggle room, and is that something your firm would then want to essentially suss out of this board of directors?
Director, there is wiggle room for that. Absolutely. And we would want to understand that and what direction the board and staff as an extension of implementing board policy would want us to do. So that's a very important aspect of this program. The way the California Code works is, I know you're aware of this, but I want to repeat it for everybody that's listening in. The California Government Code provides the authority to invest public funds to the board, and that board delegates that to staff. But ultimately, the buck stops with the board. So as policymakers, we would want to know the will of the board if the investment program needs to be ratcheted a little bit closer to the conservative side. We would want to know that, and that would be part of the investment program. And our job would be to advise you as to what the outcomes will come from that. So yes, we have clients who really push on the limits of California Government Code. We have other clients who maybe dip their toe in certain areas. And there are others that are somewhere in between. So the answer is yes, there is wiggle room, and yes, we're ready to entertain that.
Okay, excellent. Here's a question about compensation. Obviously, you've proposed a fixed fee per year. The other firms did the same. But is that industry standard, or are there any, if you will, mixed fee sorts of compensation schemes where part of your compensation is fixed per year and guaranteed, and another part is based on your performance and returns that you get us?
So if I may, Tom, I think the actual fee is predicated on percent per millions under management. So it was assumed in Lawrence's staff report that, let's assume just for apples to apples,
Right.
it's 80 million. Chandler, I think, had, well, it's here somewhere, but had an X percent for up to 50 million, above 50 million, a little less, like 0.9% up to 50.6%.
Right.
It was not tied, as you identified, to performance. It was truly just under management. I don't know about industry, and I defer to Carlos on that.
Yeah, I'm just wondering if any of his competing firms do at least partial performance-based compensation.
The other two also was a percent per asset under management.
Right. Yes, right. I assumed they were this similar.
Yeah, when I look at all the 7 proposals that we received, it's all the same structure, is percentage based on the asset under management.
Right.
So I think the question to me is, do we do performance-based fees? Or is there a room for performance-based fees? So the first question was, is this an industry standard? In our space, this is generally the way it's done. Our services, because we're a registered investment advisor with the Securities and Exchange Commission, under the Investment Advisors Act of 1940, we work as a fiduciary. So that means that we're not a market maker, we're not a broker, we don't sell inventory of securities, we don't hold an inventory of securities, and there's no spread, meaning we don't buy the security at one price and sell it into your portfolio at a higher price and pick up that difference and pocket it. That doesn't exist. It's very transparent. The process is very transparent, and the only remuneration that we're going to receive is going to be that fee schedule, which is tiered. Okay, so every tier has a different percentage, and it's the average of the weighted average of those tiers. But to answer your question, yes, this is an industry standard. You may find other managers that may pursue a blended, a hybrid approach where they may employ performance-based fees. It is Chandler's philosophy that this is not advantageous to the client for the type of portfolio that we're talking about. If this were a pension portfolio, it would be a different story. If this were an endowment, it might be a different story. But this is a safety and liquidity portfolio where safety trumps and overwhelms the importance of the safety and liquidity, overwhelm the importance of return. And if you set up a scheme, it is our philosophy that if you set up a scheme where your manager is going to get compensated for additional return, you could be setting up a moral hazard where they're incented to take additional risks that may put safety and liquidity in danger or secondary to return. We don't think it's in your best interest to do that, and that's why we don't do those.
Okay, thank you for that. And I sort of figured that was the answer, but wanted to get it on the record. Might be something you want to repeat for the full board when, presuming this comes before the full board. Let's see, next question. So you mentioned capital investment programs and reserves. And of course, one of the challenges I'm sure you're well aware, any municipal board makes is, do we start saving and putting money away somewhere for what we know will be a capital reserve, a capital investment need 5, 10, 20 years down the line? Or do we not do that? And when that capital investment need arises 5, 10, 20 years down the line, we just go out and borrow money to pay for it. But to the extent that we try and avoid future costs of borrowing and we put money away, that would be money that I assume you all would help us to manage and try and get a decent return on over that 5, 10, 20 years. But do you in any way help boards? Boards have a tendency to think of reserves as just this fixed thing that you should always have sitting in the bank at all times, which is probably true for operation and maintenance sorts of reserves. But putting money away for future renewal of capital infrastructure is a little different beast, and it sometimes seems hard for boards to understand that you don't want to just all of a sudden have $100 million sitting in the bank forever, regardless of, you got to spend it down and put it into capital infrastructure at some point. Do you do anything to help board members better understand that?
We do.
And figure out the plan for that?
We do. While we're not a municipal advisor who looks at, who may do management and budget consulting to this degree, we do think about that. And I've had to kind of deal with this as a finance director at a wastewater district. But what I would say is this: most agencies that approach this, when they're trying to finance a long-term project, let's say that you're redoing your headworks, or let's say that you've got to you're expanding your plant from a 35 to a 50 MGD plant or something like that. Anybody that does anything like that, you're always going to be looking to a combination of reserves and the capital markets to be able to, meaning you're going to issue bonds at some point in the future. So we think through that. The key for that for us is to, once we can share with you what we've observed other agencies do. Your municipal advisor, whoever helps you go to market to raise that capital by borrowing, will help you put together that capital structure, and especially in light of whatever your debt policy may dictate, or if the debt policy needs to be updated. We just don't know. I don't, because that's not our primary goal. I didn't focus on anything like that, but we do think about that. The key takeaways from that are this. If you have money that's sitting around for a long time, you generally tend to target a longer duration over the long run because you know that your horizon is longer and it gives you time to be able to invest it more effectively in the markets over the long run. If you're thinking of debt service and bonding, it means you're going to have to think about paying that debt service, but you're going to have a one-time cash flow coming in from debt proceeds that are going to have to be managed. Unlike the last 15 years, we are now in a positive arbitrage situation. So those funds come in, and as they get spent down for the project, they will sit and they will earn money. And any money above and beyond your arbitrage rate has to be refunded back to the federal government. So we have to think about strategies that address that. So yes, we do think about these things, and we think about it primarily focusing on how it's going to impact the money that does sit around. But we do see what other people are doing, and of course we share our thoughts and discuss them. But we always, at the end of the day, we have to defer to the people who do this as a primary job, and that would be the municipal advisors or anybody that's doing management and budget consulting. And then of course your staff, which will have their own opinions on this.
All right, thank you. A question about liquidity. You talked a bit about it, and I assume you work with staff to ensure that we don't end up with too much money tied in illiquid long-term investments and then run into cash flow problems. What do you advise our staff? Where do you advise our staff to keep funds that need to be liquid? And I assume you work with them to try and figure out how much needs to remain liquid at any given time based on circumstances. But where do you suggest those funds go?
So yes, we do. We do work with staff to try and figure that out. That's the cash flow analysis that I was talking about. To a degree, staff has kind of informed us a target amount that they're going to target to keep liquid and an amount that they're going to push for longer term investment. And that's obviously going to be two strategies. For the shorter funds, you have several options. And Director, some of these options were not available to you 3 years ago because they were available, but they were undesirable because of the just general low level of interest rates. But that liquidity piece is a combination of it could be a combination of what you're doing now using the state pool local agency investment fund, a combination of using the local government investment pools in California set up as joint powers authorities. CAMP, CLASS, CalTrust, or some of them. For goodness sake, Chandler is about to launch their own. There's going to be a fourth very soon, but that's an option for you. And I don't know too much about one of them because they're fairly new, but the other two have been around for a long time and have very strong investment teams that are well respected with good track records. It could be a combination of that. It could be a combination of setting up an automated sweep at your operating bank so that every night the money you may peg a certain amount to cover checks and wires and things like that, but any remaining amount gets swept into a money market mutual fund overnight where you get paid a higher rate and then it comes back available the next day, and that's available. These things weren't available when rates were 5 basis points. Now you're talking about 4.5% to 5%, versus 0.05. Now they're worthwhile. The last one, of course, is you can also run a separate side portfolio, which we might call an enhanced cash portfolio, where we may ladder some treasury bills or commercial paper or short-term CDs to be coming due right around when you need the money. So a combination of all those strategies are all appropriate and very successfully being implemented across the board, across all sorts of agencies in California.
All right, thank you very much. And my final question, although it's number 3 on the list you gave of California legal requirements for us, it might be useful if you could provide us with some indication of past performance. I don't know if City of Monterey would be willing to share theirs with us, but it might be useful a little bit, even though it's in terms of our decision making under the law in third place.
Director, we have provided that information. We've provided it in our proposal, and we have a long version of the presentation that you have before you that contains it, and we can make sure that staff has a copy of it, and it does include those returns. The way that we provide those returns, I think it's very important that the board understands. We provide return on a composite basis. So what does that mean? It means that we lump together every single account that we manage to a specific directive. Meaning, if you're following a strategy, we have to include every single account in that strategy. That keeps us from cherry picking the best looking accounts because they're going to differ because of timing and so forth. It prevents us from cherry picking an account that looks really good so that we can fool you into thinking that we have a better return. So that composite is the universe of every single account that we manage to that mandate. And I believe that we presented 3 different composites, 3 different approaches that might be appropriate for all or portions of your investment program. That's the first thing I want to say. The second thing I want to say is that the returns that we calculate and present to you are matched to a benchmark to give you an idea of the level of risk being taken to achieve those returns. And also the benchmark serves as a measure against how we did versus the market, basically. It's a yardstick on the return. The last thing I'll say is that all those returns, everything I've just described, follows, and you may want to write this down because this is something you should ask of every candidate you're looking at. We follow GIPS, it's called GIPS, Global Investment Performance Standards. And that is a framework that has been developed by, the association used to be known as the Association of Investment Management and Research, AMR. They changed their name several years ago to the CFA Institute. So the CFA Institute helped launch Global Investment Performance Standards, and that is a worldwide standard for presenting returns. If you ever see returns from a manager, your first question should be, are these GIPS compliant? Because if they're not, then you can't compare apples to apples. You can't hang your hat on what they're showing you. So it's important to know that we follow GIPS standards. We're compliant. Those have been provided to you in our proposal. They're in the longer version of our presentation, and we'll make sure that you get them.
Thank you very much, Mr. Oblitz.
Thank you, Tom. Mary Ann?
Let's see, I guess it would be just a question. I've been listening, so agency operating revenues, we would figure that out, what we need to cover payroll and all that before we set any investments. So that there will be coming from here.
It would be joint with them looking at our cash flow analysis, not only in short term, but over the long haul with our capital project list and when cash would be necessary. So it would be a joint effort.
Would we be, and then we talked about, I've heard about the investments that we have, being conservative, moderate risky, higher returns on the risky, but it's risky for the agency. So, heard about that.
Director, if I may make a comment about your last, what you just pointed out. So obviously there's a risk associated with everything, as you're correctly pointing out right now. I think that's important for everyone to remember. Within that scope, within that conversation, I just want to make sure everyone understands that the types of investments that California Government Code allows the district to invest in the overall scheme of things, are considered some of the safest investments on the planet. So there's risk and there's risk. Yes, we would be looking at adding longer maturity securities, which carry a little bit more risk. As you correctly pointed out, we would be looking to diversify into non-governmental issuers, which carries a little bit more credit risk. So we do our best to mitigate that risk wherever possible, but there is always risk. You're absolutely right. But do keep in mind that if we were to compare this to a pension fund, this is going to be way less and
Thank you. That gives me some ease of mind. Also, and you spoke about the bonds, that it would be AAA rated bonds, and those are really safe. I know that I've seen them before, or we have invested up with another agency before, and they were pretty low interest. Is that the government rate? Is there a government rate, or is it the close of the Dow Jones?
So
percent.
none of these investments, the Dow Jones is an equities index, meaning stocks, and none of these investments are stocks. So you're not invested in the stock markets. When you hear the news say the S&P 500 is down 3%, or if you hear the Dow Jones, that's not you. You're not allowed to do that. You're not allowed to buy the stocks of companies. Stocks are equity positions. You become an owner in that company. You're not allowed to do that. You can only buy bonds, which are a loan. You're lending money. So because of that, most of what we purchase is rated. And again, you mentioned the AAA rating. I mentioned that the one sector that we will be looking at will be supranational debt. The three issuers under that umbrella are the International Finance Corporation, the Inter-American Development Bank, and the International Bank for Reconstruction and Development. They're well, just look up the Washington Supras, SUPRAS. So those are AAA rated. They're smaller market. Sometimes they're harder to find. We will be buying treasury debt. That means debt that Uncle Sam is borrowing from you. That is still, despite what you saw in the last week, it is still considered the reserve of the world, and it's still considered some of the safest investments because the United States has always paid its debt. I do want to highlight that Treasury debt, as well as the federal agencies of the United States government, are only AAA rated by the ratings agency Moody's. Standard & Poor's and Fitch now rate those at AA+. But Supras are AAA rated. That's what we'll look for. They're, depending on the size of the portfolio, there may be some funding agreements for their medium-term corporate notes. They may have one AAA rating by at least one rating agency. Most of it will be in the AA and single A world. If we think of the investment grade world, that is issuance that is considered the very, very best. The very best is AAA. There's probably 5 names in the world that are AAA, followed by AA. There are several names in the AA world, followed by single A, which is again a bigger universe, and then followed by BBB. And BBB is the lowest in the investment grade world, meaning of the best of the highest quality debt. You're not even allowed to buy BBB. You can only buy single A or above. We're really talking about safe, low volatility, conservative investments. Everything has risk, but what we do here is we try and stick to the least risky sector of the investment universe. That's what code allows you to do. And then within that, we do a lot of risk management strategies to diversify, to not be too concentrated in one maturity or one sector or one issuer for that matter. That'll come through as we collaborate with staff to update the policy.
Thank you.
Thank you. Any comments, questions from the public? None? Okay, we bring it back to the board. Consider recommending awarding a professional services agreement.
Move approval.
Second.
Motion and second. All those in favor say aye.
Aye.
Motion
Can
carried.
we, discussion? We get one more discussion, just a quick
ahead.
question. So after the second, so I know that this here is more higher up and we're looked at it and staff has looked at that. What, so on the bid, on the RF request for proposals, I guess, are on the bid. So well, do you feel that would have any of these other people who may come back at us? Because it is an upper number. I mean, it's low, but.
Yeah, I mean,
upper number. You feel confident?
feel confident. I'll defer to Jim a little bit, but this is, as a professional service, it is, the selection is based on qualifications and competence, not necessarily the costs. So the cost is more of just for the committee's information and certainly the board. So I think we are fine there.
Okay, thank you.
Okay, all in favor, say aye.
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 Motion carries unanimous. Right, move on to item 8. Received draft budget for the fiscal year 25-26, Pure Water Monterey.
Okay, today I'm presenting the update on the fiscal year 25-26 budget. Let's go right into slide number 3. This is the slide that I presented last time, and I get some feedback coming from the director to make some changes to the presentation. So we look at the total revenue for the wastewater fund is 83 million. Operating reserve is 51.4 million. Debt service 2 million. Customer assistance programs around $200,000. And the CIP carryover from the current fiscal year is 17 million. And the FY26 budget, the CIP is 31.4, and the information service is around $900,000. This brings the FY26 CIP for the wastewater fund to 32 million. Let's move on to the next slide. I want to share with you. In the last presentation, director requests us to present the operating reserve and capital reserve separately. This is how I do that. For the FY 25-26, the wastewater fund, the operating reserve is based on the operating expenditure. Day-to-day operation is around 2.3 million. This represents 5% of the operating expenditure. On the capital side, there was like a misunderstanding last time. The capital reserve is related to the CIP. Again, is that capital reserve are set aside for unexpected equipment replacement within the wastewater fund. So I put the definition at the bottom to clarify what is the capital reserve. So the total reserve for the wastewater fund is around 4.5 million. Let's move on to the next slide. Last presentation also requests a definition on the pension and fund actuarial liability. Here's the definition. The UAL is the difference between the amount of future benefit of a pension fund that is expected to pay out versus the asset that we currently have in the pension fund. So when we look at the UAL, we have 3 tiers of retirement. The first tier, we call this a classic member that was closed already. So that means any member of any employee of the Pure Water Monterey who joined the agency before 2013, they will be under the tier 1 3% at 60. And you see the tier 1 3% at 60 with like a huge unfunded liability of 35 million. Because we do have a lot of Nike employee, they have already retired under the tier 1. So that's why the tier 1, the UAL is 35 million that high. And right now, as annually, we pay around 3 million to pay down the UAL for the tier 1, and is expected to paying through 2045. This will be will pay off the 35 million. And for tier 2, it's a 2% and 55. So those are the classic member who transfer from other government agency under the CalPERS to the Pure Water Monterey, and they are no longer eligible for the 3% and 60 because it's closed already. And for the new PEPA member, they joined the CalPERS after 2013, and the retirement formula is 2% and 62. And most of the new employee that hired under the that we hired recently, they are the tier 3 PEPA employee. Any question on this? Okay, then move on to the next slide. Next slide, there was like a question about the UAL. What happens if there's like a change in the UAL? How this will impact the agency? we take a look at under the tier one, the UAL is calculated based on the investment return. Like for example, if right now the investment return CalPERS assumption is 6.8%, the one in the middle, the current assumption is 6.8%. If the investment return reduced by 1% from 6.8 to 5.8%, then you see the unfunded actuarial liability will going up from 35 million to 48 million. On the other side, if CalPERS, they make some investment gain and the investment return increase from 6.8% to 7.8%, then you see the UAL decrease significantly from 35 million to 23 million. Other factor that will impact the UAL is mortality rate. So that means the more retiree in the system, then that means the UAL will be going up. Let's take a look at the assumption. Assuming that the mortality rate is 10% below what CalPERS project, so that means we have more retiree in the system, then our UAL will increase by 35 million to 37 million. On the other side, unfortunately, if we have a very high mortality rate, so that means we have less retiree in the system, then our UAL will decrease from 35 to 33 million. So those are the major factors. Of course, there are lots of variable factors that might impact the UAL. Again, it all depends on how many retirees we have, how many active employees that participate in the system that help to pay off the unfunded liability. So those are the major factors that will impact the UAL. Next slide, please. Okay, here's another assumption that we have a different tier of employee, assuming that they all earned $100,000 a year, and the first employee A is a classic tier 1 employee, work in the system for 15 years and retire at age 60. The second employee work in the CalPERS for 10 years, is a classic employee, but is under tier 2 and retire at 55. And employee C is a prepper employee, work only for the agency for 5 years and retire at 62. So how to calculate the annual pension is based on the salary plus the year of service and plus the retirement tier. So on the far right-hand side is the annual project pension payment that they will receive when they retire. Again, for the employee A, tier 1 is based on the single highest year. And for employee B and employee C is based on the average 3 years single highest, average year of the last 3 years highest salary. Okay, move on to the next slide. In the last presentation, there was not always, there's a request looking at the WRA budget, divided that into operating budget and the capital budget. And the operating side for the SVRP is 5.2 million. And Director wants you to know is how many capital projects that we request. For the SVRP, we request 2 projects. The first one is to develop a master plan, cost around $300,000. And the second one is the switch gear replacement, is around 1 million. Total request is 1.3 million. And during the discussion of the WRA staff, and only the second project is approved at $400,000. Next slide, please. Next slide is looking at CCIP. The operating budget is 2 million, and we request $200,000 for the booster bump, and they all approve because it's a lower CIP request. Next one is the SLDF. Operating budget is 1.6 million, and we have a 2 small CIP projects in the amount of $125,000. It was approved by the WRA. Okay, next slide, please. There was like a question on the CAL OES grant. What is that about, the $200,000? The CAL OES grant is related to the cybersecurity. how we enhance the cybersecurity effort within the M1W and also the cybersecurity training to the staff. Okay, next slide, please. Okay, now we look at the operating budget. In our last budget presentation, we're looking at the wastewater fund, renewable energy, CIP project, and the WRA budget. Now we are looking at the final budget. Fund 58 is the Pure Water Monterey. There are two major revenue sources for the Pure Water Monterey. Those are the revenue from the recycled water sales and the debt and capital contribution from the Monterey County Waste Water Management District and the Marina Coast Water District. Total project revenue from the two agencies is $17.7 million. The table below summarizes the operating expense as $13 million, and the overhead expense is around $500,000, and the total debt service payment for the SRF loan is around $4.2 million. So this brings the total expense in line with the project revenue. Next slide, please. For the FY 25-26, there are only two capital projects because most of the expansion project will be complete by the current fiscal year. So for the next year, we have the switchgear replacement is around $900,000, and the new storage building is $500,000. This brings the total CIP for the next fiscal year is $1.4 million. Next slide, please. Okay, now we change discussion a little bit, focusing more on the agency-wide staffing. It divides into three columns. The first column is the prior fiscal year, is fiscal year 24, and the second column is the current fiscal year, FY 25, and the last column is FY 26, the next fiscal year. And under each fiscal year, there are three columns. The first one is the full-time employee, and the second column is the part-time employee and the temps. I want to inform the board member that under administration, we have 11 part-time employees, and 10 of them are the board director under administration. And the last column is the total. So on the far right-hand side, I summarize the major changes from the current year to the next year. First of all, finance, we will add one retired annuitant into the finance department. That person will be working around 980 hours. The retired annuitant will be helping out on the new system conversion because the director approved the enterprise resource planning system, and this person with a lot of history on the current system, this person will help on the mapping on the general ledger and the system conversion. And the second position that was added is related to the information services. They add one full-time control system coordinator. And the last position that add is in the field maintenance, is a full-time distribution mechanic 2 position. So for the new fiscal year, total headcount is 130 employees. This includes 109 full-time employees and 21 part-time employees. Of the 21 part-time employees, 10 of them are the board directors. Any question on this slide before I move on? Okay, next slide, please. I just mentioned we have total headcount is 130 employees. And out of the 130 employees, some of them are allocated to different projects outside the Pure Water outside the Monterey Water. 7.5 equivalent FTE, they are assigned to the SVRP, CSIP, and the SRDF. The total FTE allocation to WRA, as you can see, is a 7.5. Again, those 7.5 is combination of many different positions. Like some of the positions charge 10%, some of them charge 30%, some of them charge 50%. So when you add up all those percentage, they're equal to 7.5 FTE. And for the Pure Water Monterey, it's 8.5 FTE get allocated. So there are two pie chart at the bottom. The one on the left-hand side show the full-time employee distribution. So plant maintenance around 62 employee. That is the biggest share, is around 57% of the total workforce. Administration is around 31 employee or 28%. And the other is like the water recycling, the WRA and Pure Water Monterey is around 16 employee get allocated to those two projects that represent 15% of the total FTE. And the pie chart on the right is the staff distribution. So we do have 109 full-time employee, 11 part-time employee, and we have 10 board member. Next slide, please. Okay, the next step is I'm going to finalize all the FY26 budget and all the funds that will be presented to the board director in April. And we have scheduled a budget workshop in mid-May, and then the budget adoption is scheduled on June the 2nd. And this concludes my presentation. I'm happy to answer any question that you may have.
Thank you, Lawrence. Look to directors. Questions or questions?
Could go back to slide 4, please. I think it's further back. There we go. So thank you very much for clarifying operating reserves versus capital reserves. I note, and the clarifying note about capital reserves is very useful, where it says capital reserves are funds set aside for unexpected equipment replacement. Do we not have a capital reserve fund for future expected infrastructure replacement?
No. What we have, per the board policy, is there's the unexpected, and then the goal was to continue to build that up to make sure we had a percentage of our overall capital plan in the bank. So if there was some dramatic revenue change, we could continue with capital investment. But in terms of, something you mentioned earlier of, we know we have this giant expenditure in 10 years and let's put money in the bank for it every year. We do not have that sort of.
I would certainly hope we could get some director's nods saying it might, if we could develop that, that might be a good thing to have, because that would be the one that would, as you look at how much money's in that fund over time, you're definitely going to have a sawtoothed sort of view of that. And I just think from a planning perspective, we ought to be deliberate about those sawtooths.
And one of the things that finance is working on is with a outside consultant looking at the 10-year CIP for the next 10 years, do a projection on the cash flow. And one of the most important elements is to looking at the debt service coverage ratio. Because right now, as we do have the SRF fund that require 110%, and the USBR and the WIFIA loan is 125% of debt service. So we are very mindful about make sure that we have sufficient cash that was set aside. And the other important thing is when S&P, they look at the rating of the agency, all they care about is how much cash we have in the bank and whether this is equivalent to at least, like most of the water agency, they do have 180 days to 360 days of cash in the bank. That is unassigned, that is not set aside for any specific project. And that is extremely critical to have like a very strong cash reserve balance, especially like if you are planning to do any bond financing moving forward. So a good credit rating, so that means like our borrowing rates will be lower and more favorable to the investor. So we are working with the consultant and planning to do a presentation to the board in the near future once we finalize the CIP plan for the next year, plus also the next 10 years as well, before we can do the cash flow projection.
But
Well,
point
yep.
taken in terms of bringing to the board, planning for those longer term things. Certainly the 10-year, that's going to help us understand.
Right.
But, you know, we all sit here and know, I'm just going to pick one asset, the outfall. If and when that needs a significant rehab or has a failure, that's a large dollar amount.
Right.
So would it be prudent, or would the board like to have a separate set aside reserve to fund future outfall improvements?
And having that and having a policy on it certainly would also, I think, help with the other requirements that you were just mentioning that we have to maintain for loans that we do have, would certainly help. When the sawtooth goes down, it'll go down only because we spent some of that money, rather than borrowing money, we spent some of that money putting infrastructure in the ground or on the ground. And I would expect that would be that other folks who might loan us money would want to know that we were planning for this and that this was all part of a logical scheme.
The challenge we have, and I think this committee should certainly know it, is we've been raising our rates over the last 7 years. Prior to that, you know, there was a series of years where it was very flat. When you look at our projected capital expenditure of 500 million or more, that's a lot for 65,000 accounts.
Mhm.
So the balance, as Lawrence is saying, is between reserves, operational cash flow, somehow getting $500 million to invest in all that stuff out there. There's going to be a little give and take. There's only so many levers we can get our hands on. And certainly one is debt service, which our bond rating is significantly important. So I would love to have reserves for significant assets out there. That may not be in the cards in the short run as we try to catch up on some of our deferred capital investment.
Quite possible.
But that's the beauty of, we'll get there and we'll show you.
Right. And, you know, that I alluded earlier to that rather important board decision-making of balance between borrowing money at the time you need it for a future project, but knowing today we're going to need that future project and putting money away. You don't have to put away an amount of money that you think is going to pay for the entire project, because that drives rates. But maybe, you know, the board policy piece is, do we target half of that future to put it away and finance the other half? Or do we only put away 25% and finance the other 75%? You know, that balance is something the board needs to struggle with.
I think, you know, and Ron may be able to speak to this, but my understanding is past boards had more of a pay-as-you-go type philosophy, which impacted the reserves we had. So certainly when I came on board, there was very little because it was a pay-as-you-go type philosophy. Is that consistent with your understanding?
Yeah. Board made that choice.
And that meant we burdened everybody with current borrowing costs
Mhm.
for a long period of time. So it's right. Let's see. So on page 6, I just want to note, it's interesting to see that the market, whether returns go up or down in the market, has a significant impact, beneficial or negatively, on
That's correct, yeah.
unfunded liability. More people dying faster or more people living longer doesn't have anywhere near that same level of
That was the one.
Yeah, that one.
impact, right? So
Yeah.
don't.
So I think with the current investment environment out there, I think it do have a significant impact when CalPERS, they close the book by June 30th. Then most likely the investment return will be significantly below the 6.8%. Then that means our unfunded liability will be going up significantly, and most likely we won't be able to pay off by 2045.
Which is a bummer, but for whatever reason, CalPERS seems to historically overestimate how well they're going to do. But if we could go to page 8, slide 8. So Monterey County Water Resources Agency did not approve expenditures on a master plan. Is that a correct conclusion from this slide?
When we have the discussion, they are going to do their own master plan.
Okay, so we're not going to be spending money on that. And then they only approved 0.4 million instead of 1.0 million for switchgear replacement. Are we managing to do a complete switchgear replacement project for 0.4?
No, so great point. The reason it was brought down to this is there's some existing funds in fiscal year 24-25 budget for the switchgear design. And the remainder amount, I think the contract that was given to TJCA was in the ballpark of 500,000. So $100,000 this year, 400 next year. So in future years, what you're going to see, hopefully, is the actual construction, which may be in the $10 million range. So we're in communication with Water Resources Agency on how do they fund that. But that will be in fiscal years 26, 27, and 27, 28.
So a better characterization of that item is switchgear replacement planning?
Planning design.
Planning and design?
Yeah.
Yeah, it might. Because I would have gone away from
Yes,
this
that's
slide
correct, yeah.
thinking the whole thing would be done for $1 million.
No.
Okay, all right.
So a comment on that, our GSA is gonna fund that.
Okay.
That our GSA is gonna fund that engineering.
That's awesome.
GSA is also considering funding other upgrades.
Wow, where did you get the money? Never mind, that's.
State dropped 10 million on us, so
Oh,
Stigma came in.
Oh, wow.
That's great.
That
You
is
guys owe
wonderful.
us some of that too.
Yeah. We'll talk, we'll talk. Okay, where's my next one? Sorry, I'm looking for my remarks here. Oh, I just wanted to say thank you very much for breaking out the Salinas Valley Reclamation Project from CSIP, from the Salinas Valley Diversion Facility. That's
You're
real
welcome.
helpful.
Hey, just to give you a heads up, I have to leave soon to get to this next thing. So I could leave, but I just don't know how that's going to work with your
I
situation.
might have to bug somebody for a ride or
Okay.
take the bus or whatever. MST works. It works pretty well, you know,
Yeah.
when they come by. They don't come by that often. Slide 13, please. So this one's labeled Pure Water Monterey Budget Highlights, but then there's a line item where the County Water. Is that the County Water Resources Agency?
Water Management District is Monterey Peninsula Water
Oh,
Management.
Monterey
Monterey-
Peninsula.
That was like a typo.
Yeah, okay, thank you. I was confusing the heck out of me. All right, that explains it. All right. See if there are any others. Oh, yes, on slide 15. So this fiscal year, our total was 128 employees or FTE, if I'm reading the bottom of the middle column of the chart correctly. And then next year's proposed 130. But you named at least 3 or 4 new positions, I thought, unless I misunderstood what you described. So
There are positions that was like like for example, when you look at the revenue collection, there was 5. there was 5 full-time positions in the current year, and then for the new fiscal year, we changed one of the customer service rep from a full-time to a limited term. So that means there's always like a position in and out, but the bottom line is they do have like a 5 employee. The same as like in finance, we add 1 retired annuitant. And then when you look at IT, they add 1. So that means that add up to the total.
So the positions that you were describing as new, in some cases are replacing existing positions?
Yes.
Okay,
yes.
that's how, all right.
That's
that
why, yeah, the
explains
numbers
it.
are not, the
Right.
discrete numbers are not by each individual
Yeah.
position.
Page 16. So for the past 2 fiscal years, total on water recycling for agriculture was 2.7 FTE, now going to 7.5.
Yes.
I don't have a problem with that. But I do want to ask, does County Water Resources Agency okay with that?
We present this information to them multiple times, and they are okay, and they have already present to their
Okay.
finance committee and to the board.
Yeah,
in
just-
post budget.
Just want to make sure they were on board with that.
And this is part of, when the audit occurred and we're having a little more dialogue with the Water Resources Agency, what had happened before is from the FTE, from the budget perspective, it was like, there's this many people. But when you drill down and look at how many people allocated time to those
Right.
projects,
Right.
then in reality, it's 7.5. So the budget isn't that different. It's just the allocation as we report it that is different.
And it sounds like we're doing a little, as a consequence of the audit, it sounds as though we're doing a little better job essentially accounting for people's time towards specific projects. Whereas previously, the difference between 2.7 and 7.5, almost
lot.
5 employees was
Yeah.
probably getting captured in quote unquote indirect costs.
It was actually
Some way.
captured in, a lot of it was still in direct costs. It's truly what Monterey County approved in their budget versus what was in the budget document, like allocating positions to them versus, so hypothetically, maybe Tyler's allocated to them, but you all worked on it. Well, now we're trying to add up your hours in totality and report that in FTEs.
That's all my questions. Thank you. Sorry about being long-winded.
Mary Ann, you got anything?
No,
You don't need this is just a report, right?
Yeah.
Okay.
Just to receive. Okay.
All right.
It's receiving the draft budget.
All right, we move on. Is there any public comments on this? No public comments.
Thank you for offering, Tyler. That's not a problem.
There's a pickle here if somebody wants it.
Oh,
Really?
yes, yes, yes.
Right. Move on to item 9, staff reports.
The only staff report I wanted to remind the committee, Lawrence had at the end of his slide, is that we're getting to that time of the year where with Memorial Day on a Monday, we're shifting some board meetings. So we have it May 22nd, which is the board budget workshop. We won't really have any other items on that other than just focusing on the budget. Then the true operational board meeting will be June 2nd, where you hopefully will approve the budget, but there'll be other items. So just wanted to confirm that your schedules are up to date.
May 22nd is a Thursday.
Yes.
All right.
I don't have any other report.
Oh, I think that's it.
Okay.
Thank you.
Committee members' comments.
Thank you very much for good staff work. If Paul and Jim could briefly stay on once the meeting's over. Just have a question.
Yes.
Nothing? I don't have anything. I think that winds us up to adjournment. Thank you all.
Right.